Good morning, all. Thank you all for joining in. It's a very busy Diwali weekend. It's a long weekend also. So, thank you all for tuning in. So, today's topic is large caps, the rising opportunity. Now, why we chose large caps? Of course, everybody on the program will know that we have been talking a lot about large caps and how we have to invest in this space. Uh, so going ahead, I just wanted to start off with giving you some facts. See, the entire presentation is going to be data. They're all going to be facts. It's all taken from industry data. It's all public data. There's nothing that I had to calculate or anything of that sort. Just two, three slides that we've used internal data, but everything is public data. So whatever I'm going to show you here is all public data, right? So in this year alone, right, we've had 37 million unique MF investors that are coming in, right? Which is a lot, which obviously means that yes, we are getting more and more interested in the mutual fund space. We are getting more and more interested in financial assets as a savings vehicle, right? Which is a very good start for us. So from where we've been coming 20 years back to where we are now, today we are at a 47, 46 lakh odd crore moment, right? That's our AUM. So if you look at our SIP data, we've crossed 16,000 crores, which is a huge milestone. Right. So kudos to everybody here because you are a big contributor to this number. And the best way for an investor to save money in India is to do SIP. It's the best. It's the best. It's a no-brainer. You just keep contributing on a monthly basis, and you keep building on that one particular area in which you're building or looking to invest. Right. So these set of unique investors have participated, and we've had our mutual fund SIA moment again, 16,000 crore plus sort of SIP flows. In fact, 2 days back, the number came in for the October month, and it was around 6,000, sorry, 16,900. So we are almost reaching the 17,000 crore mark, right, which is a big number. Now, we've also reached all-time high industry assets, right? So we are at a 48 lakh odd crore uh, asset under management. And if you see 28 lakh crore is only individual investors, which means we are driving this sort of growth. We are participating, we are bullish, we are buying into the India story. We do believe that yes, this is the only vehicle that is going to give you that sort of high return. Right. Everybody is buying into this. Yes, it makes a lot of sense. So yes, everybody is investing, everybody is going into mutual funds as an investment. Right. Now, if you look at this 48 lakh crore, 54% of it is in equity, right? Which means almost half of it, 20 or 24 odd lakh crore is fully in equity. Right? Debt is a 32%, which is a small portion, but compared to equity, it's a small portion. But compared to the rest, you should see multi-assets, nothing. It's just about 2%. If you see hybrid, it's just about 9%. Uh, so everybody's money is going up, and everybody's money is going into equity alone. Right? Your debt allocations are low. Your hybrid, multi-asset, international, they are all very low, but a majority of it is going in equity. Right. Now let's break up this component because we've all sort of come into this market, and everybody is going only in one asset class, right? If you see, retail happens to be 76% of this entire 28 lakh crore AU, right? And this is all public data. This is ICRA's data, and this latest data, September data. So if you see less than 24 months, which is less than 2 years, right? New investors less than 2 years, 56% odd is coming up under your new investors, right? 1 to 2 years. So people who have no experience or any of sort, first time investors or investors who invested but lost out on time, they did not invest for a very long time and now they are back into the market. So the average age of the folio, right, is less than 2 years, which means that all investors that have come in the last 2 years have come up with that expectation that yes, we are coming into this with very high returns because COVID was a year where everybody, after that, everybody made a lot of money. Let me be blunt. A lot of small caps went up, a lot of mid caps went up. Basically, there was a broad-based rally across the world. It was not only in India, right? So that expectation is still there. And you see, yes, we are still very naive. We are still very nascent. 2 years is what we have sort of come in. Now, where do you think most investors invest their money? It's a good poll. You can put in your answers in uh, the chat box. So option A is small cap funds, option B mid cap funds, C is flexi cap, and D is large cap. So where's investors' money going? Of this entire 28 lakh, 50%, uh, where are investors sort of going out and investing? You can put your answers in. Okay, we have one answer, small cap. Then we have flexi, we have small again, we have small again. Oh, one large cap, and then we have flexi, small cap. Okay. Okay. A majority of you said uh, small caps. So let me look at the data. Let's look at the facts. Now, where's the money going? If you see your small caps and your multi caps, right? Because multi cap is quite small, but if you see your small cap, there's a double jump from just 2 years back. So it's a 96,000 crores to now 1.98 lakh crore, right? Which is a lot, which is almost double. So it's going, money is going into very expensive places of the market. It is going into very expensive places. Yes, somebody commented saying yes, based on past returns, 100% yes, this is all based on past returns. This is where you come in saying yes, these are companies that are young, these are companies that can offer you more returns than large cap or mid cap. Yes, it's true, but when you pay a high price for it, like what investors are paying now, the amount of money that you can make incrementally, you're losing out on future returns. Right? This is where most of your money is going. Now, if you look at your large, right. Your large caps are somewhere on the lowest side. It's around 24%. There's no growth that has come in terms of assets under management from the large cap funds, right? If you look at ELSS, yes, it depends. It comes, for investors who are in a particular tax bracket, yes, ELSS works for them. But if you look at others, if you look at Flexi, if you look at Focused, anything that is more large cap oriented, the growth has not been very strong. But if you look at mid cap, yes, 62% jump. Multi cap, yes, we've seen new funds coming in, and hence they have gathered that asset. But in terms of risk, wherever there is risk that the investor perceives, there is where the investor is going, right? Because investors assume high risk means high return. No, high risk does not mean high return. High risk means high risk. Right. So yesterday we did a space where we were addressing what is risk. Along with me on the space on Twitter was Nakul. He is a financial planner here at iThought, and he said fear of loss, and I said no, it's not fear of loss, it's loss. It is permanent loss. Right? It's not a fear of loss. It is actual permanent loss. That's your risk. That's the risk that we are running. Right. And if you see, most investors are going with that mindset that high risk means high return. High risk means high risk. It's very, very simple. Right. Now, just look at it in percentage terms. Today, 10% of all AUM is small cap. If you see large caps, it's been dropping. It has definitely been dropping. If you look at mids also, it has remained extremely stable. So our AUM has gone up. At the same time, more money into small caps, more money into mid caps. Yes, this is wherever there is risk, money has gone there. Right. Now, is this sustainable? Now, why is this that really happened? One, I think somebody commented saying yes, based on past returns. So if you look at over the last 5 years, even if you look at over the last 12 months, your small and mids have done about 35%, whereas your large have done about 15%. One reason, yes, performance chasing returns, and that keeps happening. And that is something that every investor should be aware of, that yes, where am I going? I'm going into a place where everybody is running. It's the same race that everybody is running. So the probability of me winning that race is very, very low. And if you look at your 5 year CAGRs, Nifty happens to be only 12.5%, and mids and smalls are more than 12.5, right? More than 12. So it's about 18% and then 16%. Right. So going just based on performance of the last 2 years, the last years does not bode well for investors. If you go into asset and classes where you're paying a lot, you're intermittently foregoing future returns. Just it is very, very basic. It's very, very fundamental. Right. Now, let's take a closer look. Net flows, which means net people who have taken out money from small caps and people who have put in money into small caps. It's just a net. If you look at the net just this year alone, your net inflows into small and mids have been 29,000 crores and 16,500 crores. And you look at the large cap side, you look at the largest chunk of the entire market. Right? Investors are taking out money. They're not that they're losing money, they're taking out money. Right? They've taken out 3,700 crores in the entire year. You saw that chart, you saw that table in which, yes, assets under management are not growing. It's not growing because people are taking out their money. Right? And they're going into avenues in which they're going from uh, what they perceive to be extremely conservative to what they perceive to be extremely aggressive. Right? Aggression doesn't mean that you have to do something that is beyond your comfort zone. Aggression means you show some sort of conviction in that particular market in whatever opportunity that comes to you. So, taking a closer look, small and mids, the inflows that have gone in have been extremely large this entire year, and large caps have had a good amount of outflow this year. Now, they are going out of favor, which means that money is going out, and the investors that are coming in also are extremely low. So, which means when you look at the new follow additions that have come in, your small caps have really gone up. Investors are really, really bullish on small caps. I really want to attend some sort of seminar or workshop that says, yes, show me some data in which, yes, you can make incremental profits on small and mid caps in the mutual fund side. Right? Uh, you look at the folios that have gone up this year, around 40% odd folios, new additions of folios. Mid caps are about 15%, and large caps is nothing. It's the same. It's just about 0.8%. It's nothing. So the idea that I'm trying to put here is that yes, there is crowding that is happening in one entire part of the market, and one entire market which I'll show you in the later stages of the presentation has a lot of opportunity. And why is it that investors are not looking for that opportunity? And here you are, where we are providing you that opportunity. That no, look here, stop looking there, look here. Right now, why have large caps actually gone out of favor? It's a real question to ask. Now, we had a SEBI recategorization of large cap funds, in fact all mutual funds that came in, and the recategorizing of schemes happened in October 2017, where SEBI came out saying there are various categories and we have to mandate this entire investment universe for each category, right? So accordingly, large cap became there was a proper definition of large cap. Say top 100, 1 to 100 is large cap, 101 to the next is mid cap, after that, after 250 is small cap, right? So after that, what has happened after this entire recategorization? It's taken the industry since then about 5 years to change their funds, to change their construct, and to make sure they are well put together in the right place. Again, we had another SEBI mandate came in that multi-cap, fixed cap can't be the same, right? It has to be you cannot have two, three separate categories like this, merge it, have separate, right? So if you look at the percentage of large cap funds outperforming the benchmark on a 3-year rolling period, this is a little dated, but if you go through recent presentations of the really good AMCs, this data will again be there. So there has been a significant reduction in the percentage of large cap schemes really outperforming the benchmark. Right? After this entire categorization, large caps have not really outperformed. Right. Yes, the industry was going through some bit of a turmoil. You had 2 years of correction phase that came in broad based. Even globally, we were having problems. Our interest rates were quite high. We had to bring it down. Right. So we went. It took us 3 years, and then 1 year of COVID happened. So we've been resilient. Right? We have gone through the change. We have gone through COVID, and we have gone through a very bad economic phase also. Right. So we have gone through it. We have come out very resilient. No, large caps have gone out of favor. So you look last 5 years, because of all these issues, you saw that the average returns of mutual funds over the Nifty 50 has been very low, right? But if you look at the olden days, yes, it has been on par or they have outperformed in a very significant manner, right? So active management does work, but in phases like this where there's intervention and where there is a lot of changes in terms of regulation and we are having a bad economic phase, definitely yes, there will be some problem. Right. But they've been resilient. Active management works only in those places. Now, let's look at large cap as the rising opportunity. Right now, I showed you the facts. Right? There's crowding out that's happening. There is low return that's happening. So it's an extremely good opportunity for us to be contrarian in that manner. So let's look at some more data on large caps. Now, what is the share of large caps as a total percentage of the entire market? What do you think is the total share of large caps? 50%, 35%, 65%, 80%? Okay. There is SDA 50, 80, 80, 65. Then again there is uh, sorry, 65. Lot of answers, lot of mixed replies. There's 65, 65. Okay. 80, 65. Okay. B. Okay. Somebody said 35. Okay. 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 So it is 65%. Right. So investors who said 65, kudos to you. But what's worrying is the share of mid and small caps. They have gone to an all-time high of 35%. So mids have gone. So if you look at the last bull run, the last bull that happened was from 14 to 17 for small and mid caps. This is when broad-based rally really took place in the market. And if you see from then, from a high, so if you look just from 14, right, it was about 80, 75, 80%. And from there, we have come down to 65%, right? Nothing has happened to the companies. The companies have only gotten stronger. Large caps have only gotten stronger. Yet, because everything else has done well, this share has sort of come down. Right? There's nothing fundamentally wrong with large caps. Right? They're the largest. They're irreplaceable. They cannot be replicated also. So incremental money has gone there. So if you look from 14% has become 17%, 9% has become 17% for small caps. Right. So the last time we had such a big number of 35.5% of both mid and smalls was in 17, which was about 32%. Then you know what happened for the next 2-3 years where we saw a deep decline. Right. And this scenario is different, but this scenario doesn't mean that something like this won't happen. Yes, you have to be very cautious. You have to be aware that yes, there are risks when I'm buying into an avenue or saving my money into places where valuations are extremely high and the risk is higher. Right. So it's not that this is bad and this is good. No, no, no. It's just that where is the lowest risk? Right? Where is the probability of me not making capital loss, right, for a long period of time? Because this option and because this opportunity is available to us, right, where we see no, this is much better and that is not feasible for me because of valuations. Not that the companies are bad, not that the operations are really bad, no, but you're getting something better. You're getting something better at much cheaper price. We are Indians. We are only going to go shop when there's a sale. We will not go buy MRP at all. You see e-commerce business, I'm going to Amazon just because I can get very good discount. I'm going to Myntra because I can get really big discount. So it's the same thing that applies when you save money. You save money only when there's a discount, and wherever you find a deep discount, save your money there. Right? Why do you want to pay a premium? So the premium that investors are paying for mid and smalls are much higher than what you can pay on the large cap side. Okay. That's where the opportunity really lies. That's where the opportunity is. Now let's look at large cap. Right. This is what we're talking about. How the total size about 186 lakh crore, 1 to 100. Then your mids are around 45 lakh or sort of crore, and your smalls are 41 lakh or crore, right? The smallest that are coming. So you see the size, the change in the delta that's there for both. Now, why large caps? Now large caps are very well established companies. Everybody knows them. They're very financially sound. Now we had a corporate restructuring that took place. We were deleveraging during that phase. That's why you saw large caps also underperforming, and larger companies were driving this sort of deleveraging. So we saw a good phase of deleveraging where right now we are in a very financially sound place than we were 5 years back. They provide you stable and reliable growth. Let's be honest, we want stability, right? We want to be able to grow at high rates for 10 plus years, right? Right. We want a vehicle that's like Maruti, goes at Maruti speed, delivers also like Maruti. It's not that we need a Ferrari or Lamborghini and then go crash, and then we have to come back saying I had a bad experience in the market, so I don't want to do this, right? These are your savings, so take it very seriously. These are your life savings, so take it very seriously. Would you take would you go on in a Ferrari when you know that somebody is a very reckless driver? No, you will not. So take it very seriously. These are life savings. They have been proven to weather downturns and operate profitably. I have some data on that also to show you how one particular fund has really done in all crises put together. And they have a really good corporate governance. That because it's global standards. So yes, they have to. They are large, and they are market leader. They are not replaceable. They are a market leader. That's why they're extremely large. That's why they've been large and resilient for a very, very long time. They are market leaders. So when you're able to get a market leader very cheap valuation, right, you should not wait for it. You should start saving your money with market leaders, right, rather than looking at how much incrementally I can grow from here, right? No, you are getting high growth at extremely cheap valuation. So yes, you should look to consider. Now, the large cap advantage. So if you look at large caps, the large cap entire stock is 35 times the largest mid cap company. Right? That's what the power is of large caps. Uh, so if you look at the smallest large cap company, it's only 49,000 crores. If you look at the smallest mid cap company, 90,000 crores. Right? Smallest, the 500th company is 5,000 crores. Right? So that's what the data is, 35 times by market cap of the largest mid cap stock. So you're getting the largest, right? Comparing mid cap and large cap, or you compare small cap and large cap, you're getting the biggest at extremely cheap valuation, right? I have a valuation chart also that shows that. Key advantages, this is not something that I need to explain also, is very, very evident. It's obviously mature risk profile is stable growth and their proven business model, right? So everybody knows this. There's nothing for me to cover in the large cap advantage. Now, which sector had the largest weight in the Nifty 50 index in 2005? Was it banking, IT, oil and gas, or FMCG? Okay, we have IT. I think three investors have raised their hands up. If there are any questions, I'll take it at the end of the PPT. But if you do want to reply to this poll, please do put it in the chat box. Okay, somebody has told. So there are a lot of banking and IT. Then there is one on FMCG. There are two on three on oil and gas. So I think, okay, I'll just put out the chart. If you look at 2005, oil and gas was the highest, followed by IT. Today, you are at a large banking level and a large IT level. So you see, today it's skewed towards banking, but in 2005, it was skewed more towards oil and gas. And again, in 95, it was skewed more towards consumer goods. Right. Indexes keep changing, benchmarks keep changing, market leaders keep changing. And if you see, had an investor sort of gone into banks in 2005, in 2015, it has almost doubled. Like the weight just of financial services has doubled, right? Which means that yes, over years, an investor does make extremely high returns by just going by following one of the market leaders that are there. Right. So it was the third largest, right, in terms of the weight. And if you look at oil and gas, yes, from more public, it has shifted to private. If you look at IT, though the share has dropped in terms of percentage, but yes, a lot of wealth has been made in these sectors. So market leaders do generate extremely high wealth for you, right? Where you're taking lower risk, where you're able to incrementally make higher returns on your savings. Right? So it's not that you have to try too hard. Yes, you just have to stick through, contribute continuously towards that particular revenue, and wait it out and be patient, and everything will sort of come your way, right? So actively managing. So if you see the index and if you see what the mutual funds are doing, I've just taken a subset of large mutual fund, large cap funds. They are about 10 large cap funds that I have taken. If you see, yes, they are actively managing. They are taking up that concentration risk. They're making sure that yes, we don't give you the sort of concentration risk that what the index does you or gives you. So if you see, yes, they are underweight banking, they are underweight IT. That doesn't mean that they are not investing in the banking space. They're not investing in the IT space. Definitely, they are investing in these spaces, but they are actively managing performance. Right now, that is what is the risk management that they always tell you that no, they are taking well calibrated approaches. They are tactically managing your money and making sure that you are well allocated towards growing parts of the market. Right, you don't want to miss out anything growing parts of the market. Right. Now, this is a slide that I had taken from our internal PMS, which is the large cap PMS, where I wanted to highlight what is the true power of a large cap. Now, True Blue is our large cap PMS. It only takes the best companies in the Nifty 50 and allocates money accordingly. So, True Blue has about 21 stocks, and these particular companies, right, these businesses, they are 26% of the entire Nifty 50's profit pool. Right, that's how large these large caps are. So why do you want to go to a place where the contribution that is coming in from a profit pool perspective is very less? So your profit pool percentage of a large cap, right, itself is extremely high, right? That's what the power of a large cap really is. Right. Now, let's look at some valuation metrics. You saw from 18 to 3 years, we had very low ROEs, and that's when you saw that we were going through a really tough time. And right now, yes, we have caught up. So we have caught up, but the money is not really going in. The money has not caught up yet. So here's your opportunity. The money has not caught up, right? But fundamentals have caught up, right? Fundamentals have caught up, earnings have caught up, and it's a great place for you to look at. Now, let's look at the power of a large cap. I've just taken one specific large cap. This is not a recommendation to buy anything on this. So this is pure data. Right? This is only pure data. Uh, so if you look at what usually a large cap does in this scenario of 2008 2009, the fall was lower, recovery was higher. Again, in a crisis, the fall was lower. Post, yes, recovery was higher. Again, you had a slowdown, the fall was lower. Then you had recovery that was higher. You look at Corona, fall was lower, but the recovery that came after that, that's where your problem lies. That's where all these regulatory changes have gone out and impacted this entire space. That's where all the structural changes that came in into the economy also has sort of gone out and affected the large companies, the investor sentiment towards large companies. Right, it has nothing to do with the fundamentals. It's only investor sentiment. Right. So here you have a place where it works for you. It always will work for you, and you are able to get these businesses where they are fundamentally extremely strong now, but the money has not really gone in. Now, if you look at performance across cycles, here you see, yes, they have been extremely resilient in a fall, and they have covered up really well in a bull also. Right? So they have extremely low volatility, and they're able to create alpha because they are very you're not taking that extra risk, right? So your alpha that you make on whatever risk that you're taking is low, right? So if you see the standard deviations also, they're quite low from a just the top 100 perspective. And if you see the Sharpe ratios, they are also quite resilient in terms of what you're paying for risk. You're very well adequate, right? Now, is it the right time to invest in large caps? Yes, you're seeing earnings go up for the next 2 years. The estimates of earnings that are coming in, they're very high. If you compare it to uh, the previous history also, you are having earnings that are quite high. So which means you're getting more, but you're paying less. Right? So if you see from an average perspective of what your PE, PB ratios are, just your fundamental, simple vanilla valuation metrics, yes, you are not paying much for it. So the best approach for an investor right now is for large cap. And the way that you should look at large caps is from a SIP perspective. It's the best way for every investor to invest in this sort of a market. Uh, India is poised and is the only country that is going to offer you 7% or sort of return, and definitely 7% or GDP growth. So definitely, there will be a lot of light that comes into large caps when they see extremely strong fundamental, sustaining fundamental growth. So yes, SIP and STPs are the best way for any investor to take advantage of large caps. Right. Now, what should an investor really expect? This is again a chart that we developed internally. If you see the first 3 years, it's going to be volatile. Be honest, be honest with yourself. It's going to be very volatile. The next 3 years after that, sort of moderate. And after 5 or 6 years is when you see your money starting to work for you. Right? Any investor who's working for more than who's had their money work for them for more than 10 years, you are seeing somewhere between 10 to 12 or 10 to 13 sort return. And every time you grow at 12.5% or 11.5% sort of return, compounded for 10 years or so, you're effectively doubling your money every 6, 7 years, right? So you can comfortably create wealth, you can comfortably grow here. There's no need for any investor to take risk. But right now, the risks, the odds are in your favor for you to create alpha by looking at large caps and not other aspects of the industry or other avenues in of where you want to invest. Definitely there will come a time. Definitely there will come a time. 14 to 17 was that time, but definitely you will get that time, right? Even for that matter of all, anybody, any investor who would just participate in the market, yes, would have definitely generated some amount of money. But the point is for you to sustain, is not for you to make it in one cycle, it's for you to sustain many cycles. And this is one opportunity that has been resilient and been able to generate and sustain high growth. Right. So now I think I will open the floor for questions. Please do put in your questions in the chat box. Is there a current recession in the US or any predicted slowdown in the short time? Please put in your questions in the chat box. Uh, for those of you who have raised hands, is there a current recession in the US or any predicted slowdown in the short time? See, there are slowdowns. It's not that it's a very large slowdown, but things are very polarized. In the US, the large are again doing extremely well. There was a slide on how large caps have done both here and there, but I did not find that to be a relevant comparison. So I had not put it here. But there is data that says that yes, the large caps and the larger companies that are more technology oriented have done extremely well. Every other industry has not done well. So it's very polarized, and growth is coming only from polarization, right? Only particular sectors are contributing to growth for the country. Which sectors for long-term growth in India? Uh, See, services-oriented companies are poised for growth. We did this webinar on banking on our other products. We've covered auto. We are trying to cover other sectors also. So do attend those webinar. It's there on YouTube also live. So you can look at what we are talking in terms of sectors for long-term growth in India. But my point is that it's not just going to be one particular sector. There will be they will lead, but every cycle has a different market leader. Every cycle there's a new winner. And for you, the best way, if you want to participate with the winners, you want to participate in these sectors, you have a basket approach. And having a basket approach works. See, I've put out a lot of data that says yes, and within the large caps, you know that there are some heavyweights, and obviously the benchmark would run a risk of concentration. Right? So, and the only way where an active management or an active manager can mitigate that risk is to diversify into other sectors. But when a time comes to back these sectors, definitely they would uh, park the bus. So, yes, I've explicitly told you as to what you can look at. So, do look at that. For a large cap investment, can we start investment for long term in index mutual fund, which is better than FD? See, mutual fund is better than FD, right? And inflation, right? Any equity is going to be better than FD and inflation. When it comes to index mutual fund and when it comes to basically passive versus active. Now, uh, when you're looking at passive, you can look at passive as a complement to your active, not active complementing your passive, because active is going to look at Nifty, the entire 200 sort of companies, right? Or Nifty 100 is where the universe is going to be. That's the universe of operation, right? passive can be something that complements your active, not replacing your active. Right? So wherever the active fund is going to lack in terms of themes or sectors that you might be bullish on, that's where your passive can really come in and do a good job. But if you do active mutual fund and a broad-based passive fund, then you're doing the same thing. There's nothing that you're going to benefit out of. You have to complement each other. That's where you're going to. That's where your money is really going to work for you. Right. How do you think election is coming here and how is it going to impact the market? Uh, Prime ministers keep changing, governments keep changing, but policy matters and policies have been extremely strong. You are already seeing how policies have contributed to the manufacturing sector, to infrastructure as a sector. But elections can come and go, prime ministers can keep changing, majority, minority, all of this is going to take place. But policies is what matters, not somebody who's at the wheel. You showed a slide where there has been an increase in investing, but which one has given the highest return? Small and mid caps have given you the highest return. That's what the slide was. Uh, let me try to go back to that slide. Yeah. Yeah. Performance of mid and smalls have done extremely well, no, in the last 1 year. In the last 2 years also, you see they covered up a lot. And that's why incrementally money has gone here. So it's not that performance has come and then money has followed. It's hand in hand, right? Money goes in, it's performance comes in. Performance comes up, money goes in. It's a virtuous cycle, right? And they are all thinly traded. No, they are float is very less. So it's all thinly traded, keeps on going up. So money keeps going, it's all getting crowded. So it's not fundamentally something, the valuation re-rating something that has happened. But yes, there have been re-ratings that have come in that entire ocean. But so that is where our PMS comes in. You should look at the how we run our small cap PMS here. But broad-based in the industry, it's a virtuous cycle. Uh, when going for index investing, Sensex 30 or Nifty 50 is better. If you look at index investing, like I said, passive should complement your active. If an active is going to do the same job of Nifty 100, then you should look at an active because they're all well research companies. Uh, and fund managers do have a great amount of experience when it comes to managing these funds. So yes, you should look at active. Passive only comes when you're complementing the active, like something like a sector, something like a theme, where the active fund manager has not gone overweight on because of their conviction, and you can add to your conviction with the passive. Whether you do Sensex 30, whether you do 50, it's the same thing. It's the same large cap. Okay. Where can I find the recording? Which channel is it streaming on? It's there on I thought PMS. Is there on Milestones2Wealth. If you just go to the live, it's on YouTube. If you just go to the live, you'll be able to see all our webinars. And when we do a webinar, we are very transparent. We put it out. We are doing a lot of videos. We do a lot of spaces. We are very transparent when it comes to putting out data. Right. Large cap is a good investment, but are you thinking that there will be a fall for recession in the upcoming? So I don't know if there will be a fall that comes up. If you look at domestic flows that have been coming in, it's been extremely strong. We have been supporting the market here. No, it's not. There's nothing. We have been putting in that money. You saw. That's why I put that slide on how a lot of investors have come in. A lot of investors who are the average age of the folio is less than 2 years. We've had all-time high SIP numbers. So domestic institutions will obviously keep on buying, right? We are putting in that flow, right? So in just in terms of market fall, we don't know when something bad would happen, but we also know that something good is lined up for us to happen. So very tricky. So what do you do in this sort of scenario? You take it slow. You don't leave out the opportunity. You participate. You don't sit on the bench. So you keep on contributing, and something bad happens. You'll obviously have something. Keep something as ammunition for you when something bad happens or something wrong happens. You should be willing to contribute at that point of time. So it complements and it works hand in hand with a lump sum plus an SIP sort of strategy. Recession, inflation and interest rates are quite high globally, and they've not seen this level. So risk is there outside. Inside looks a little lower than outside. In a nutshell, do you mean the market outlook for 2024 is to go favor blue chips? See, in a nutshell, whatever you have understood based on the next year or the next to next year or the next to next year is not 1 year. Right? I think what I've understood is 1 year. What I'm trying to tell you is 10 years. Right? Uh, for India to keep growing at 7%, your larger companies need to get larger, right? And for them, if a larger company has to get larger, many opportunities will open up. Fundamentally, they have to get stronger, which they have been getting stronger. They have to deliver, which they have delivered, and the economy is giving you and supporting you that sort of growth, right? So if India is expected to grow for the next 10 years at very high rates, then naturally somebody has to lead it, and who will lead it? That is up to everybody's guess. Rather than taking a single guess, take a basket guess. Any guess on when will the craze towards small cap end? You tell me when will this craze of small cap end? Uh, we've been seeing this craze for a long time since 2017. You're seeing the data, but as long as there is information out there that says high return, high risk means high return. This is the only way where an investor can make money. No, no. Yes, investors can make money, but will they do it in this particular cycle? It's a doubt. Yes, there will be an opportunity. 100% there will be an opportunity that opens up. Right? We don't have to leave this out. Right? But that doesn't mean that you have to compulsorily go participate or something that you will miss out. I'm telling that you will not miss out on anything. That's all. So when we go to a store, also, if a watch doesn't come to us at a discount or anything that is very premium that can offer you that sort of luxury or that growth doesn't come to you at a discount, you don't go to. You will wait, come after 2 3 months to see if something is there, whether a credit card give you discount or something like that. You'll also go. So same thing I'm trying you to follow here also. We don't know when the craze will end. And we don't know whether this is a craze that has to end also, right? But you have to be cautious. You can't follow something. You have to be very cautious. Okay, big question. How can we take advantage of the large cap opportunity? The opportunity in any cap is not always compelling on a comparative basis. How do you help taking advantage? How do you address when large caps will become overvalued? I have not seen sell calls. See, in terms of the advantage, whatever I have told you, they are opportunities for you. This is data that you should be aware of. Right, this is happening in the entire market. Where do I stand now? Right. When the opportunity comes for a large, mid, or small, on a comparative basis, the only reason of why we get confused or why we have this dilemma of taking a decision is because we've seen that doing extremely well. So we say, no, 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 I want that one. Right. Now, suppose that one does not do well. So from 18 till 21, the small cap CAGR was only 1%, 2%. Right? From high to high. That's basically a high to high, right? So there investors don't make money. Then you again start thinking, no, 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 I think I made a mistake. So I want to go there. This problem comes only when you think that no, that is giving me a better opportunity. No, what I'm getting now is not really good. I want that, right? But had an investor stayed for the next 2 3 years, if in that entire space from 18 to 21, I've had a bad experience. 21 to 20, I have an extremely good experience. Right. So you be patient. You have to be patient. So you have to take that advantage. Now, if you're investing in a particular, or let's say you think you have done a mistake, where you've contributed in, one particular avenue that has not generated to you return, what are you going to do? Your best approach is to SIP and average down, and the next SIP that you do can be in another place, right, where you want to take up that opportunity. So both ways it works for you. That doesn't mean that you should stop the tap on one thing and open it on the other thing. No, no, your taps have to keep running. Right. And yesterday also we addressed it. Diversification doesn't come from doing flexi, multi, large. It's the same thing. It comes from asset classes. It comes from equity. Where do I want to be on equity? Where do want to be on the debt side? Right. Where do I want to be on hedging against recessions that keep on coming? How much gold do I need to have in my pocket? You need to have a proper plan. Okay. Only then you'll be able to take this advantage. Only then you'll be able to compare right. Otherwise, you won't be able to compare right. How do you address when large caps have become overvalued? Like how we are addressing small caps are overvalued, like that we will address how large caps are overvalued. Because large caps, HDFC Bank, your views on it. Please don't ask me stock specific questions. So we have done a banking webinar on I thought PMS. You can check it on that YouTube channel. Anything you want to know regarding that sector, please go check that webinar out. Do follow us everywhere on YouTube or Twitter, Instagram also. We are putting out a lot of webinar invites. That we are doing many webinars. We are doing a lot of investor education sessions for you to know what best to do. Any specific theme sector which can be better than large caps? There are definitely. Depends on your risk profile. Depends on your risk appetite. Depends on your risk profile. There are many sectors. Now, when you go outside, yes, they will tell you you can do this, you can do this, but not every shirt fits everybody. Right? What suits you, what suits your risk profile, you can look at that particular sector. What kind of economic reforms can be expected in the next 5 years in global and domestic, as well as which sector can be gained through that? There are a lot of obsession in terms of which sector is going to do well. What are the economic reforms that can be expected? Uh, so, what economic reforms we've been talking about? You can look at our corporate India webinar, but broad based, we are concentrating more on infrastructure. We are concentrating more on manufacturing. Uh, See, when in 2014 it was Make in India, now it has become Make in India for the world. Right. So we transitioned a lot. It worked for us, and now we are heavily investing in infrastructure. We're heavily investing in manufacturing. You're seeing a lot of PLI schemes coming in. So yes, these are the economic reforms that are happening now. It's not that something that can happen later. It's happening. It will only evolve and only keep getting better. There'll be a lot of supporting aspects that come along, but focus is more infrastructure driven. That is domestic. Globally, also the case is to go towards infrastructure and to be more energy efficient. Right. That will take us a long time. It will take us 10, 15 years to put up capacity to become more renewable for the share of renewables to work. But the whole point is to build energy efficient solutions for everybody. Right? That's where the reforms are. Important ratio to analyze large cap stock growth. Now, all ratios are important. That's why I said for an investor, and I showed you that chart of how 76% are retail investors. Right? Of the 28 lakh in equity, 76, the majority are only retail. If you get too obsessed with one particular ratio or three, four particular ratios are past, it's not forward. So you're looking at data that has worked previously, not that is going to work now. Right? You can get an idea. Okay, this has happened in the last 2, 3 years, and that's what these ratios indicate. That doesn't mean that it's going to happen. This is not something that you should fixate upon. That's why rather than looking at one, two, or three, you should look at a basket. A basket works for you well. Right? So one ratio is not, or two ratios are not really. All ratios are important, and industry specific ratios are extremely, right? Unique unit economics are extremely important. And which sector ETF goes well with large cap active mutual fund in the current market scenario? Uh, So you need to see how many sector ETFs are there. It's a good idea for me to look at and do a presentation on ETFs. So, but thank you for that idea. I will definitely look into it. Uh, in terms of the ETFs that are available for sectors, you have IT, you have auto, you have banks, you have within banks, you have private banks, you have public banks, and whatever suits your risk appetite, you should do that. It has nothing to do with growth. Your risk appetite maybe, yes, I can afford to take growth and I can take extreme risk. So you can go into an extremely risky area of the market that can complement your active fund. Okay. Uh, that doesn't mean that uh, you're going to miss out on your active or you're going to miss out on your passive. Everything will be complementary of you, but you have to work according to your risk profile. Uh, in your last slide, you showed if we stay invested in large cap, we can generate up to 10% compounded. What about we stay long in small and mid cap? That I think is I think it has been done in the Vriddhi presentations. That I don't know if it is there readily with me now, but I can definitely look into it. And 10% is not compounded, that is giving you. The chart is very clear. If you stay, depends on where you started also. Now, if you started at a high in 2010, then it's 10%. But if you started somewhere at a low, then definitely it's more than 10%. There's somewhere where you're getting 15%, somewhere where you're getting 14%, somewhere where you're getting in large caps in 17, because mostly investors were going into small and mid caps. It was 14%, right? So it's not 10, but it varies from when you have to start or when you start, right? So and you can always make it work for you. If you start at a high, whenever there's a deep correction that comes, you should take advantage. You should definitely keep some ammunition ready with you where you can take advantage of it. What are all the checkpoints to select one particular large cap fund of many AMCs? Any large cap fund is okay to invest at current scenario. If you're not on the program, do sign in for the program. We will guide you to do this. Sign in for the program, and we will be able to guide you. So we are already running this sort of strategy, and this is where we give our inputs of you know what what part of the large cap we are doing, where we are going out and investing. Uh, so do get onto the program, and we'll be able to guide you very well. What should be the downward or upward cost averaging method? SIP is your best method, right? Like I said, SIP is your best method, because it's a no-brainer. You have to continuously keep providing corpus to that particular mutual fund, to that particular basket. There's a broad-based correction that comes up. Definitely, you should take advantage as a lump sum, small lump sum, incrementally. It's just supporting. It's just supporting. It's like feeding your child. When a child is extremely hungry, feed it more. Right. But if it's not, then you give normal food. But this is the strategy that you should do. SIP, every year review what your SIPs are doing. Step up your SIPs because you're saving more. You're growing. Your salaries will grow. So save more also. So save more, and then if a correction does come or it doesn't come also, keep something in your hand that you can use at that point in time. Be it up or down. Up is better for you to put in more SIP. Down, you can take advantage of lump sums. For a young investor, if they are investing in large caps, is there any potential for them to hold for the long term? See, for a young investor, if they are investing in large caps, first understand your risk profile. This has nothing to do with because I'm young, I'll do small cap. Because I'm young, I'll do mid cap. I have lots of time. No, no, no. First, you are young. First, you need to get trained. Right. And the best way for you to train is to understand your risk profile, understand what your goals are coming up, work according to your goal. If your goal is retirement, then yes, you can take somewhere you can bat on the front foot. Right. But if your goal is something where I need to build a house, I need to have, some contingency to travel because I'm young. That way you can't stick to, taking this. So first set your goals right. Once you set your goals right, then you can talk about, okay, where I'm going to invest. Your first step as a young investor is not to see where I'm going to invest. Your first step is to see what my goals are. Right. Second, how much I'm able to save, what am I earning, how much am I able to save after my expenses. And after that, then is your next step to say, okay, as per this goal, I'm able to save more. So this goal requires me to save this much amount. Have a proper financial plan, right? And then only start contributing towards these goals. Right? That's the last step to come, whether it is a large cap or a mid cap or a small cap. Your first step is to choose a particular goal, right? And then work towards that goal. How much to be contributed to that particular goal? Right? Only then we'll see whether it is a large cap, mid cap, or a sector. Which YouTube channel is streaming this complete live? I think it's Milestones2Wealth. But either ways, it will come up in a day or two on YouTube. I thought PMS, I thought we'll have other webinars that are going on live. And we are doing a lot of reels. We are doing a lot of short form videos. We are doing a lot of spaces now on Twitter. So uh, follow us. If you're not on the program, do get onto the program. This is where we can guide you on which large cap fund to do, which small cap fund to do, which mid cap fund to do. So we will go according to the opportunity that works for you. Right? We will go according to what your goal is. Right? So that's what we are. That's where our role is going to come in guiding you as to what to do. Right? Uh, if you have further questions, do type in. We have a couple of more minutes. But if you're not on the program, do get onto the program. Okay. SGB has performed very well. Yes, SGBs and gold ETFs, mutual funds, they are the best avenue for you to save money if you're looking to invest in gold. They are both best. In one way, you're getting 2.5% interest, and the other way is just growth. But yes, both are really good. And gold is not something to trade in and trade out, it's all for long term. So have a long term approach, be locked in. Doesn't matter, but you have to contribute to gold, and these are the best avenues. If you're going to use it physical, you can bear the storage cost and everything, then you can go for physical. But yes, these two work best for you if you don't want to bear it. You want to bear it, other costs that are coming up with having physical gold, and you want to use it, then it works for you. But yes, both are extremely good for gold. We have done a gold webinar also. It was long back. uh, it's there on social media. You can look it up. And if any investors want to have another session on gold and gold mining, do message us, do let us know, and we can arrange something for you. So it's no problem if you join very late also. We will upload everything on social media, so don't worry about that. Done. I don't think that there are further questions. So let me close here. Uh, Thank you so much all for joining in. Very happy Diwali. Have a very prosperous Diwali to you and your family. Cheers. Take care. Thank you.